USDJPY gets slammed as Japanese investors bet on Fed action to reduce US interest rates. So guys, really key driver of dollar yen, USDJPY, is the difference in interest rates that you get on US bonds and Japanese bonds. So this is something that's important for FX markets in general, but particularly for this cross. Basically, you got to think from the perspective of an investor. Where would you rather put your money? In a country where you get a higher rate of interest or a country where you get a lower rate of interest? Obviously, you're going to pick higher. So typically, that means that investment in the US is favored because they have higher interest rates than in Japan. However, sometimes what you see is if interest rates in US bonds or US assets starts to decline, whilst interest rates in Japanese assets starts to go up, yes, the level of US asset interest is higher than the Japanese, but the gap has narrowed. What you see is some flows going from the US into Japan, and that manifests itself as weakness in USD and strength in JPY. Obviously, it can go the other way as well. What matters is the difference, the rate differential, either closing or widening. And guys, this has been a really key driver of dollar yen in the last couple of days. So last week, we saw a big sell-off in US government bonds, and that means yields went up, interest rates went up. And that meant that dollar yen went up as well because money flowed out of Japan and into the US to chase these higher yields. But we've seen a big reversal in that trend. And a lot of analysts are speculating that this is because Japanese investors have all of a sudden decided to bet that US interest rates, rather than keep going up, they're going to come down again because of the Fed. Now, guys, stay tuned because I'm going to be releasing a blog, basically a primer for the Fed event tomorrow. But one of the things the Fed is thinking about at the moment is something called yield curve control, which is basically where they set a target. They say, for example, the 3-year US government bond yield cannot go above 0.25%. And they ensure that this target is met by buying as many of these bonds as is necessary to keep the yield at this level. Basically, you want low yields because it's cheaper for the government to borrow, which is good for the economy and the economic recovery, all that kind of stuff. That's why the Fed are doing it. But Japanese, by the way, this program is not certain by any means, but it appears that these Japanese investors, being cited by traders and analysts, have been betting that the Fed is going to do that. They are going to push interest rates in the US down, which is going to close the rate differential between the US and Japan, which is why we've been seeing that weakness in USDJPY. Hope that helps. That is pretty much it from me for now, and I will see you in the next one.